Testing. Welcome to the Home Professionals Network. I'm your host, Sean Williams. I'm a real estate agent at Maybaum Real Estate. A lot of you already know me, and some may be new, so welcome. Um, what we're going to be doing on the Home Professionals Network is giving you a chance to learn about the home buying process. It's a lot of moving parts when you're trying to buy a house, and we want to kind of try to put it all together for you. So, what this show is going to be about is you. We want to make sure that anytime you have a question, you can always tune in to the Home Professionals Work and get the information that you need. We'll answer your questions live on the show, and we'll do whatever we need to walk you through the step by step process from getting approved to buy a house to fixing your credit to a number of things that you will encounter when you're trying to purchase a home. If you're trying to sell your home, we're going to have some very good tips about you listing your home, putting it up for sale, learning about the market, and a number of other things that we're going to do. We're going to be here every Monday at 7 p.m. During the week, I'll be doing a segment called Ask Your Realtor. This is where you can actually come on the show live with me. You can email me, text me your questions, and I'll do a video and just answer your questions. Nobody have to know who you are, but if you want to come on the show and show your pretty face, you can be side by side with me from the comfort of your own home, and you can get your questions answered and be on the show. And speaking of comfort of your own home, this is another effort for us to be COVID safe during this time, during the pandemic. I hope you are all safe. And sometimes during this pandemic, you do have to get out there and deal with real estate and stuff like that. And we're doing it the safe way. A lot of the stuff that you need to get done can get done right here on the Home Professionals Network. Each week, we're going to have a different guest on the show that's going to be very instrumental in the home buying process, from real estate agents to loan officers, attorneys, interior decorators. I'm talking about every phase of the home process is going to be right here on the Home Professionals Network to help you to get through this thing called real estate. Today's guest is going to be Vanessa Fox from Gill Mortgage. Vanessa has been my go-to loan officer for a number of years now. Like I said, she's a loan officer over at Gill Mortgage. I met her when I was a loan officer. So she's going to come on the show today to give us some tips, to let us know what you need to do to buy a home, what steps you have to go through, the approval process from beginning to end. She's going to be here to talk about it. So without further ado, I want to bring on Vanessa. How you doing, Vanessa?
Hello, how are you, Sean?
I'm doing good. We're here on the Home Professionals Network. I want to welcome you, and we're going to get right into it. Start off, I want you to tell us a little bit about yourself.
Well, my name is Vanessa Fox, and I work for Gill Mortgage. I've been in the mortgage business about 20 years, a little over 20 years. And I think I've done everything from being a loan officer, business manager, and a broker. So I kind of have a well rounded sense of what this business is about.
Good, good. Okay, now a couple of questions I do have for you, Vanessa.
Okay.
I know that getting pre-approved is going to be the very first thing that we have to do, but what are some of the things that people have to do to get ready before they call you to get ready for a mortgage?
Well, basically, I think the most important thing for a person to do when they're contemplating buying a home is to get all of their documents together, all of their income documents together, because that's going to be critical when we're determining how much house you can buy. Uh, and determining your debt to income ratio, because that's pretty big when you are buying a house. Um, and then the other thing, I want people to not to be afraid. Don't be afraid to uh, to pick up the phone and call a mortgage professional and get a mortgage analysis done prior to trying to contact an agent or anything like that, because you
Right.
need to know where you are
Right.
financially and with your credit scores and that kind of thing. So don't be afraid to call us. We Most of us have seen everything out there, and we can give you some good guidance on how to proceed.
Okay. Speaking of credit score, what should a person be if they're trying to buy a home? What would they want their credit to be?
Okay, our minimum credit score is 600.
Okay.
Okay, but it goes without saying, the higher your credit score, the better your interest rate. So you can get a loan, a mortgage loan at with a 600 credit score, um, but you'll get a better interest rate if you're above 640. So I would aim for the 640 credit score, but again, we will do a mortgage for you at 600.
Okay. Now, what if a customer comes in and they're like, they're maybe, let's say 580, 575, 580, but they want to buy a home. They're not too far from 600. What are some of the things you can do to help to get them where they need to be?
Okay. These days, we have a automated program called the What If Simulator, and I use it religiously. There was a time when early on when I would try to figure out, well, what if they paid this down? What would this do to their credit score? I don't do that anymore because some people don't realize it. If you pay certain things down or you pay certain things off, um, it can lower your credit score. So the what if is it is a program that we use a lot, and each credit repository, so Equifax, TransUnion, and Experian, they score differently. So what we do is we analyze your credit by repository, because maybe something that you will pay off or pay down, which will increase Experian, might lower Equifax. So we're going to look at all three of your scores. We don't go with the highest score and we don't go with the lowest score. We go with the middle score. So we kind of concentrate on the high score and the middle score. Um,
Okay.
by
Okay.
I don't know if I'm saying that correctly, but if you don't understand it, just kind of ask me a question.
Okay. Yeah. Um, so with this what if simulator, let's say, like I say, if someone came with a 580 credit score, it actually tells them exactly what they need to do, and you'll know how many points their credit score will go up, and they can move forward with the assurance knowing that they'll be where they need to be if they do the things that you tell them to do, right?
Correct. The
Okay.
only the only caveat that I will add to that is the school the what if is only as good as the person that we're using it on. So if it says for you to pay down a certain debt and you go and pay it down, but between the time that I pulled your credit, and you complete the task that the what if has set out for you, you
Mhm.
can't get anything, let anything else negative get on your credit.
Right.
And one of the things that I find that people do sometimes is they will pay down, they'll pay down one debt and then let the other debt go lacking. They have to maintain their credit. So that means that just because you're paying down your Visa card, that doesn't mean you can skip a payment on your MasterCard. You've got to you've got to do what you've been doing to keep all of your well, we call it trade lines, in order. You just can't just concentrate on something, one thing, and let the other things go lacking. You can't do that because then it won't it won't produce the type of results that you're looking for.
And when they're paying down the debts on credit cards, what do they normally have them paid down to be called satisfactory? When it's talking about your debt to income ratio or your credit usage.
Okay. A lot of people say they like to see them down 33%. But if you're really trying to get your credit scores up, then you want to pay those credit cards down to anywhere from $10 to $25. Because number one, that will lower your payment and you don't ever want to close them out. A lot of people say, well, I'll pay it off and close it out. Not. Revolving debt moves your credit scores up and down the scales. So if you are managing your revolving debt pretty well, then you'll see your credit score start to rise. Um, if I were buying a house, I would probably pay my credit cards down to like $25. Um, I wouldn't try to say utilize 33%. I wouldn't personally.
Right, good. Now, you say 600 for your credit scores. Now, is that for FHA or is that for all of your loans across the board?
No, that's for FHA
Okay,
and VA. So that's for government-backed loans.
okay. What are other loans?
Conventional, you want to have your credit score at least a 620 to
Okay,
640. Those are better scores on conventional loans. But let me just say this, just because you have a 640 credit score does not mean that you will get approved on a conventional loan.
okay,
Scores aren't everything. It's the overall utilization of your debt and how you manage your finances that's going to determine whether or not you can go conventional. Conventional loans are what I used to call vanilla loans. They're loans that you kind of have to be, you can't have a lot of negative debts. You can't have a lot of charge-offs, collections, even medical collections, because the conventional loans are just a little bit harder to get than
right.
government-backed loans.
Okay. Now, what are some of the features with the FHA that makes it such an attractive loan versus maybe a conventional loan?
FHA is a little bit more forgiving. Um, your ratios typically have to be a little bit lower. Um, but for example, if you have a lot of medical bills, well, most people don't go out and get in medical debt, they just don't go out and do that. So at Gill, if you have a lot of medical debt, but you still have a 600 credit score, we will still consider you, okay?
Okay.
Um, Charge-offs and collections really, really do hurt you. But on an FHA loan, if they're over 12 months, they don't hurt you as bad because we can do a manual underwrite. And if it's over 12 months, depending on the amount of charge-offs and collections, you won't have an issue, especially if it's under $2,000 for charge-offs, non-medical charge-offs and collections.
Okay. Now, what is a manual underwrite?
A manual underwrite is where we will look at the guidelines and just follow the guidelines to the letter. Now, if you get an automated approval through either Fannie or Freddie, through DU or LP, then whatever the automated findings come back at, like for example, on a manual underwrite, you can't go over 50%. But if you get an automated approval through Fannie or Freddie and it's 55%, we'll still do the loan because Fannie and Freddie has looked at they've analyzed your credit history, your income and all of that good stuff, and they're still willing to insure the loan. Anything over 50% on a manual underwrite will not be insured. So we won't do it if you're over 50% debt to income ratio.
Okay. That's some good stuff. Now, what about student loans? I want you to really get in depth with this right here. I'm not on the screen. There we go. I really want you to get into it with this right here. Student loans things you can do to your student loans about to get qualified for it, and how they affect you on a FHA loan and maybe a conventional loan. Let's talk about that for a minute. I really want you to get into it about this because I've had a lot of people call about student loans and trying to buy a house.
Okay. To me, at this point in time, student loans are the number one loan killer, mortgage killer, because if you got a lot of student loans, it's going to affect you. It's going to affect your ability to get a home loan. At some point in time, student loans will become due and payable. And if you know nothing else, any federal debt, they'll get it one way or the other. So on a student loan, on an FHA loan, we're either going to use 1% of the total balance of student loans. So for example, say you've got $100,000 in student loans, which is it's pretty typical, it's pretty average. That's $1,000 payment. Now, if you can show proof of a 30-year or 25-year fixed payment that you have set up with Fed loans or Nelnet, then we'll take that payment, but you've got to have documentation to show proof. On a VA loan, it's a little different. If your student loans are in deferment for 12 months or more, then we don't even have to count it.
Okay.
On a conventional loan, they can also be in an IBR program on a conventional loan. But again, conventional loans are pretty hard to qualify for because you can't have a lot of charge-offs and collections and a lot of negative debt. And so then it will refer back to the 1% or your 25-year fixed payment. And a lot of times it's a lot easier to get a 25-year fixed payment because that payment will be lower than the 1%. And no matter what, on every loan, we have to consider student loan debt.
Okay, so it would definitely play a factor in your debt to income ratio. Now, you mentioned IBR. If I'm correct, that's income based
It's an
repayment.
income-based repayment plan, but you cannot use income-based repayment plans on an FHA loan.
Okay.
We will, if you have a IBR, we're going to have to use 1%.
Okay.
And most lenders are not going to want you to just to get a quote of what a payment is. You're going to have to actually be in a payment plan. So if you have a very large student loan, I suggest very strongly that you contact whatever agency that has your student loans and, kind of see what your fully amortized payment will be. And then if it's going to be a lot lower than that 1%, which undoubtedly it will be, then I would go ahead and get into a repayment plan instead of trying to stay in the deferment or IBR, because 9 times out of 10, it's going to affect your debt to income ratio and probably will keep you from getting a home. And there's no way around it. Absolutely no way around it. We're going to consider student loans under any type of loan program you will try to get to qualify for a mortgage.
Okay, so to my people listening out there, you got to get your student loans in check when you're trying to purchase a home. And she's giving you the guidelines, and I'm pretty sure that once you call her, she'll go over case by case with you. One of the things that I want to talk about is debt to income ratio. Explain to them what it is, how it affects the loan, and what are some of the things they can do to reduce the debt to income ratio to get through this home buying process.
Okay. Your debt to income ratio is going to determine how much house you can buy. So if you're in a lot of debt, and we just look at your monthly payments, we don't consider, like, say, if you're in $100,000 worth of debt, but your monthly payments only equal to, say, $500. All we're going to consider is the $500 to determine what your ratios would be. a good comfortable ratio for your house payment would be 30% or less of your gross income. And a lot of people don't realize why we have to do it this way. But let me just kind of throw this in there. If you make $1,000 a month, okay, we're only going to consider $500 of that. That's the most we'll do on a manual underwrite. Now, whatever Fannie or Freddie, when we run you through an automated system, it may allow you to go a little bit higher, but that will pretty much mean that you have pretty good credit. But just say we were doing a manual underwrite, we won't let you go with 50% because if you work, we look at gross income. So you're going to be paying taxes. You may have other things that come out of your check a month. And so aside from all of your regular monthly debt, you still have to consider that maybe you're going to want to buy some food, or you might have a light bill that you have to pay, or a telephone expense. So we don't consider those types of expenses when we are determining what your debt to income ratio is. So um, you have to be, as a person trying to buy a house, you don't want to exceed a certain amount of your income anyway, because you still have to live. We call we call that, if you kind of overextend yourself and push yourself to the limit, we call that house poor, because you'll have a house, but that's all you'll have. So keeping your ratios under 50 and comfortably around 45, that's a good place to be. I would I would not advise anybody to um, go above 50, 55%. Then you're setting yourself up for failure. Really, you are.
Right. Speaking of setting up for failure, I've seen some customers in my years of real estate as a loan officer and as a real estate agent set themselves up for failure. And I'm gonna tell you what someone did, and I want you to tell me how they hurt themselves. And we're gonna get into some of the do's and don'ts about real estate.
Mhm.
I think you approved someone for me to get a loan. I think it was you, and we were looking for a home, and the guy called me and said, "I have something to do today. I'll get with you tomorrow so we can look at some more houses." We met the next day, and he pulled up in his brand new BMW. You take it from here.
So then he just killed his loan.
Right.
He just okay. And I'm gonna say it like I'm feeling it. You can't live in a car. You just can't. It's nice to have a decent car, and it's nice to, um, if you need a car, you need a car. But if you're trying to buy a house, first of all, number one, I would buy my house first. Car dealers don't care what your house payment is. They're just looking at your credit score. But when you come to get a mortgage, you may have had good credit when you bought that car, but now your DTI, your debt to income ratio, is so high, we're not gonna we're not gonna approve a home loan. They have a lot of predatory lending laws out there right now, and I don't know of any lender that will allow themselves to get caught up in a situation where they could actually be, taken to court and
Right.
sued by the customer um, for predatory lending, because that's just really what it is. If we know what your debt is, and we approve a home loan, and you then default on the home loan, because you're going to default on something. You're either going to they're going to repossess your car, or you're not going to be able to pay your mortgage, or you're not going to be able to eat. So something's going to happen. So we typically, I don't know of any lender that would do a loan for a person who just went out and bought a BMW.
Right. Now, in some cases, now they might have just gone out and bought that BMW and they qualify, and the debt income ratio is just fine. So it's not every instance, but it's some of the things they have to look at.
Yeah, and that's the purpose of going to a mortgage consultant or a home loan specialist, and getting a mortgage analysis. You may have some wiggle room, okay? But if you're going to get a car, if you're thinking about getting a car while you're trying to buy a home, go first to a bank or a credit union because they will pull your credit one time. If you go on a car lot, they're going to send you to multiple finance companies. The interest rates are typically a lot higher than if you would go to a bank. Um, and that can hurt your credit score too if you have like, and I've seen it, 30 plus inquiries when someone was out looking for a car.
Yeah, and those inquiries they build up and they lower your credit scores, don't they?
Absolutely.
Hmm.
Absolutely. But it's got to be like for a prolonged period of time. Say you're out shopping for a car for 2 weeks, and every car lot you go on to, you're letting people pull your credit because
Hmm.
that finance manager at that car dealership is going to send you to as many lenders as he thinks that he can get you approved through.
And get the best deal for his company.
Correct.
Right.
Mm-hmm.
And so really they're kind of just thinking about themselves while you're just taking the hits on your credit report.
Mm-hmm.
Yeah. Now, I got a lot of people that come to me to buy a home. They're self employed, beauticians, barbers, truck drivers, business owners,
Mm-hmm.
and they get paid. And I'm one of them. We get paid a little bit differently than everybody else. So let's talk about how being an independent contractor and self employed affects them buying a home and what are the things they need to do to have the things in place to buy a home.
Okay, first of all, they need to do their tax returns because that's what we're going to use. Second of all, they have to be in business for at least 2 years and they have to have 2 years worth of tax returns. Okay,
Okay.
that's first. Otherwise, you got to wait until you get there.
Hmm.
Secondly, you need to tell whoever does your taxes that you're thinking about buying a home so that they won't write off everything. Because here's the bottom line, whatever you tell the IRS that you've made, that's what you made. So if you write off everything so you don't have to pay taxes, 9 times out of 10, you just wrote off your ability to purchase a house.
Right.
Okay. Um, I think that's the number one thing that a lot of people don't understand. And then you'll be surprised. People will say, well, I really make more money than that. Well, it doesn't matter if you make more money than that, because if you lie to the IRS, we got to go by wherever you tell them. So you're shooting yourself in the foot. Um, and a lot of self-employed individuals will come to us the year before they're ready to buy.
Right.
They'll bring their tax returns, and then we will do the little worksheet, and then we'll tell them what their average monthly income is, and that's what it is.
Right. A lot of times when I have self-employed, I always tell them, even if you're just thinking about it, think about getting married, and a couple of years you may want to buy a home. I've even sent them to you about a year ahead of time to just talk to find out what they need to do, because I know you have to have those 2 years in buying a home. And, and they come to you and they only have that 1 year. Then now they have to wait. Plans have to be put off. They have to be renters for a little bit longer. So I try to send them to a loan officer to make sure they get these things in place so that um, when it's time to purchase, they can rock and roll. They can get out. We can try to find them homes. Because the bottom line is, you can't issue me that pre-approval letter that they must have. Let me say that again. They must have to buy a home.
Oh, and Sean, let me tell you what we see a lot of.
Mm-hmm.
Um, Self-employed borrowers will bring us a copy of a tax return, and we'll do all the calculations.
Mm-hmm.
Then they don't realize this, so let's get it out there. We're going to pull their transcripts from the IRS, and those transcripts must match those tax returns that they gave us. A lot of times they don't.
Mm-hmm.
A lot of people think they can be slick and give us a tax return, and then we're gonna approve them, and we're not gonna check and verify. We verify everything.
Right.
We
That's the
verify everything.
4506T, right?
Mhm. Well, you can do a 4506T, and we can send it. I mean, we can get it for you. However, during COVID, we found that it's a lot faster for the individual to go online to irs.gov
Mhm.
and go ahead, set up an account with the IRS and pull their own transcripts. So not only will you be bringing us your tax returns, but you'll also be bringing us a copy of your transcripts. Now we will go ahead and order them ourselves, but this will speed the process up a little bit because during COVID, a lot of people work from home, and so um, we're seeing that those transcripts are not coming back as fast as they used to.
Okay, so that's some
That's
good
some good
information.
information.
And
And
I
I
repeat
repeat
again,
again,
always,
always,
always
always,
let your
let
real
your real
estate
estate
agent
agent
know
know
that you're
that you're
self-employed and how you get paid. Now, if
Now,
you're a
if you're a
W
W
two
two
employee,
employee,
that's a
that's a
totally
totally
different
different
ball game,
ballgame,
right?
right?
Correct.
Yeah, because then you
Then
have
you
your
have your
taxes
taxes
taken
taken
out, and
out,
it's just a matter of just matching it up with what the income
income
statement
statement.
said, right?
Well, really, when we do a file or loan where you have a W-2 employee,
Mm-hmm.
we don't even ask for tax returns anymore.
Well, you don't? Okay.
We don't ask for tax returns. Um, so that's a little bit better because uh, some people will go out and get involved in these little smaller companies and then write off a lot of stuff uh, and just kind of mess themselves up because they really don't understand what they're doing.
Okay.
Um, but the best thing for someone who's W-2 is to just use their W-2 income and don't tell us don't don't bring all that other stuff to us because then we gotta get tax returns, and if they wrote off a whole lot of stuff, whatever you tell the IRS you make, that's what you make.
Okay. So
So
what
what
if
if
they
they
what if they
they
brought
brought
you their
their
W
W
twos and you don't
and you
ask
don't
for
ask
your
for
tax
tax?
returns? What if they
They
haven't
haven't
filed their
filed.
taxes? How does that work?
Well, we verify the income that you say you're making. You give us your W-2, and this is what you say you're making. So we will pull your W-2 transcripts from the IRS just to
Gotcha.
verify what you're making. We don't
Okay.
necessarily pull your tax transcripts if you are a W-2 employee.
So do they
They
actually
actually
have to
have to
file
file
to
to purchase.
purchase?
Um, I would file if you know I would,
Okay.
but we're not going to be checking all of that if you are a W-2 employee.
Right. What?
Now, you're self-employed, we're going to check everything.
Right. And I didn't
I
mean
didn't
to
mean to
say do
say
they
do they
have to
have to
file because
file
it's a
because it's
law.
a law.
You
You
have to
have to
do it.
do it.
But
You have to,
sometimes, yeah.
yeah,
Give you an
Give you an
example. We're in the
example. We're in
middle
the
of
middle of
COVID
COVID
right now.
right
A lot of
now.
people aren't going out. The IRS isn't open right now. You have some
mhm,
elderly people that like to go in to get stuff done. We can't do that right now. So COVID kind of
Kind of
affects
affects
how we
how.
operate when it comes to your taxes and stuff like that.
absolutely.
Right. Okay. One other question I had for you, Vanessa, was what is PMI when you're talking about buying a home? Because a lot of people
That's,
ask me about that.
okay, that's private mortgage insurance. Okay, and basically, that is, I try to explain it to people so they kind of understand it. It's like if you buy a car, right? And you put $500 down. What if you default on that car um, before it's paid off? Okay. In other words, what if you go in foreclosure when you're buying a house?
Mhm.
Okay, so your PMI will pay the first 20% of the loan amount. Okay. And then typically then the lender will foreclose on your property and resell it more than likely at a discount. So if you have 20% equity already in your property, you don't
Mhm.
have to pay PMI. It's
Okay.
only for those people who don't have enough to put 20% down. Because it's amazing that even in 2020, people still think you have to have 20% to put down, and you don't. FHA is 3.5%. conventional is 3% or 5%.
Okay.
You don't have to put 20 grand down on $100,000 house. You can if you want to, and that will help you to avoid PMI. And typically on a conventional loan, it takes anywhere from about, say, 6 to 8 years to reach that 20% um, point where you have 20% of equity built up in your house, where you can drop the PMI. It used to be that way for FHA loans, but now it's not. So FHA typically has a lot lower interest rates, but the PMI is for the life of the loan. On a conventional loan, those rates are slightly higher, but once you get to 20% equity, then that MI payment will drop off. So you will be paying less on a monthly payment on a conventional loan when the MI falls off than you will be on the FHA loan.
Okay. Now, what about VA? Does
VA, you never pay PMI. You
okay?
pay
So
an upfront funding fee, and the VA guarantees the loan. So if a veteran goes belly up, the VA buys the loan back. No
okay.
questions asked.
Okay.
Mhm.
Since we're talking about VA loans and veterans, let's explain to them the features of a VA loan, the benefits of a VA loan, and why should you get a VA loan versus a 100% loan from any other company that may be offering that.
Because VA is a government-backed loan, and government-backed loans typically get the lowest rates that are out there. Their rates are infinitely lower. So if you get 100% loan from, if they have like 100% program other than USDA, then typically that interest rate is going to be higher. That's a more riskier loan for the banks to take on because, again, somebody gets 100% loan. What if they default? Then that bank is going to have to buy that loan back. If they default on a VA loan, Departments of Veteran Affairs buys the loan back. So it's less risky for the lender. And like I said, typically the interest rates are going to be a lot higher. And so your payment will be a lot higher. And over the life of the loan, you'll pay back more money. So if I was eligible, and everybody's not eligible for VA, it's only military veterans. And if they have spouses who are survivors, like say, for example, my dad was in the military, and my mother, since he died, can still use his VA benefits. So it's only for those people. And if you have a VA loan, you can also have two VA loans at one time.
Okay.
You can use your bonus entitlement. So say if you bought a smaller house, say in 2000, and now your family size has increased. So you can use your VA certificate of eligibility to buy a larger home in the same area. So you can have two VA loans in Augusta, whereas with the FHA loan and conventional loans, you can't do that unless it's going to be investment property.
Okay.
And you have to put a larger down payment. On a
Oh,
VA loan, you just use your bonus entitlement and you just move up to a larger house.
mhm. And I want you to clear up a myth for me. I've heard some veterans come to me and say, I can get a VA loan and get approved for a house, and it doesn't matter what my credit is. Is
Not
that?
true.
It's not, I want you to get into that a little bit because I've had a lot of
That's not
veterans
true.
misinformed about that.
Yeah, that's not true. And a lot of veterans have the misunderstanding or something has been miscommunicated to them. The lender, when you get a VA loan, you're going to go to a lender and you've got to meet whatever criteria that lender has, okay?
Right.
Because, for example, if you go to a bank, their requirements may be totally different than a mortgage company for a
Mm-hmm.
VA loan, okay? And the Department of Veteran Affairs don't finance loans. They insure those loans. So they're saying, go ahead and lend to the vet. And if he messes up, we'll buy that loan back from you, from the lender. Um, I've heard some crazy stuff from veterans, and I'm not sure where they're getting this information, but they'll be treated like anyone else buying a home. The only difference is the Department of Veteran Affairs is insuring that loan and backing that loan on behalf of the veteran. So I'm not sure where they get that information from. You still have to meet the requirements of a lender.
Yeah, I've heard it a lot, and I've had to send some of them to you and to other loan officers as well for them to get the truth. Not hear from me as a realtor, but to hear from the lender that you still have to have your credit scores in place. You still have to have your debt to income ratio in place. Just because you have the VA certificate doesn't mean you can just go out and buy whatever the eligibility is. And a lot of them are saying that to me. So I'm glad we're doing stuff like this to get the word out to let
Oh,
everybody know.
let me just say this as well. A lot of veterans, they'll come in and they think that they don't have to have money to buy a house. They do. The VA will finance. Well, we can finance 100% of the sales price of that property, as long as it appraises for whatever it's selling for. But then there are other costs associated with a mortgage. There are closing costs. There are things like homeowners insurance, taxes, which we call prepaids. Those things have to be paid for. Now, it would be great if you could get the seller to pick up all of those costs for you, because they can. And on a VA loan, if the seller so desires, like say, for example, the veteran has some debt that and their DTI is a little bit high, well, the seller can pay up to 4% of the loan amount. They can use that to help the veteran pay off some debt at the closing table, to help them qualify. But there's no such thing as a free lunch. You know, you're gonna have to have some of your own money into um, into the game. You're gonna have to pay for appraisals. You may have to pay the realtor earnest money. So there are some costs involved in a VA loan. The only thing they get 100% finance is the sales price of the property.
Right. And you led me right into my next question. We're going to talk about earnest money. We talked about down payment already, but let's talk about these seller paid closing costs on the FHA, VA, and conventional loan. And then I want to speak from the real estate side of things after you answer that.
Okay, on an FHA loan, the seller can pay up to 6% of the sales price. On a VA loan, the seller can pay all of the VA closing costs, and up to 4%, and they can use up to 4% of the sales price to pay off debt for the veteran if it's needed to help the veteran qualify. On a conventional loan, the seller can only pay 3% of the sales price. And on an investment property, the seller can only pay 2% of the sales price. So it's 2% on a conventional investment property, 3% on a primary residence property for conventional, 6% on FHA, and they can pay all of the closing costs for a veteran.
Okay. On the real estate side of things, I want to kind of explain the seller paying closing costs. Traditionally, the seller paying the closing costs makes their home more attractive for a buyer to purchase their home. You purchase my home, I'll help you pay so much of the closing costs. That makes it a little bit easier because they understand that you have to pay down payment, you have to pay earnest money, pay for an appraisal, which we'll get into next. And you have to pay for home inspections, all the other stuff. So when you're talking about $5,000 or $6,000, they'll pay it out of their proceeds to help you to get the loan. But we're in a market right now where sellers not doing that, are they?
No, absolutely. And I just want to add this too. A lot of people think that the seller can pay their down payment That's don't don't they cannot. That's
Right.
mortgage fraud. You'll get in a whole lot of trouble.
Hmm.
So remember that.
Now they can get a
Um,
gift, can't they?
they can get a gift from a
Okay.
family member.
Okay.
They can't. The seller can't help them with anything other than closing costs.
Right.
That's it.
Right.
Okay.
And in
Um,
our market, we're in Augusta, Georgia here. I don't know what market some of our listeners are in, but in our market, the inventory is very low, which means that sellers, you put your property on the market, it's top dollar.
mhm.
And sellers really aren't having to pay closing costs. People are having to come out of their pockets to pay closing costs. And so some of the things people have been doing is pulling from 401ks, correct?
Yes, yes, they have. And if they want to use their 401k, we just need a copy of your most recent 401k statement and your company's policies or terms for withdrawal of money from your 401. Because some people cannot get money out of their 401ks unless they terminate their employment. So that's either, you quit or you retire. And that's the only way you can touch your 401k money. So we like to see those terms of withdrawal up front so that we'll know that they can get some money. Oh, also, some 401ks won't let you just randomly go make withdrawals, but they will allow you to withdraw money for the purchase of a home, or if you have some type of medical crisis, they will let you get money from your 401k.
Okay, so there is help if they were trying to purchase a home. A lot of people say, hey, I don't have money saved up to buy a house, or I'm not ready yet because of the down payment. So a lot of them didn't know that they can go to their 401ks, and that's what it's there for them to pull in time of hardship. And that is considered a hardship when they purchase a home, correct?
Correct. Yeah, that's exactly what it's called. It's called a hardship withdrawal.
Okay, good.
Mhm.
Now, let's talk about the appraisal and how that
Mhm.
plays into purchasing a home. And then I'm going to tell you something from a real estate point of view that's being done in this market right now.
Okay. Um, Typically, on most loan types, the buyer and seller sign something called an amendatory clause or an escape clause, um, or however you would just want to call it. Um, but what it says is that if a person wants to sell your house, say for $200,000, and that appraisal comes back low, like under 200,000, you have the option to back out of the deal because the house is not worth it. Typically most people don't want to pay more than something is worth, and that's the purpose of the appraisal, to let us know what that house um, is worth. And you'd be surprised, in our market right now, it's a seller's market.
Right.
So price, um, sometimes they're offering it to beat out other buyers,
Mm-hmm.
or they're offering it to upping the price to include closing costs. But we are frequently finding that a lot of these houses are listed um, at what they're worth. And so what that means is if the seller has not built in any closing costs for you, then you will just have to come up with some closing costs because there's no leeway. Now, I have seen maybe once or twice here in our area where a person has signed a contract saying that they will pay X amount of dollars no matter what the appraisal comes back at, but that is not something that's often done here. But in California, when I did a home loan out there a couple of years ago, that was common practice. So my buyer, who was purchasing a house in California, they paid like $30,000 more
Wow.
than the house was worth. And if that's the case, the lender starts at what that house appraises at, and then we figure out what your down payment would be. So for my people out in California, they had to do their minimum down payment plus the $30,000. And the same for the people here in Augusta. They had to do
Mm-hmm.
the same thing. They had to pay their minimum down payment based on the appraised value plus whatever was over and above the actual appraised value of the property.
Okay, now in this market, let me give you an example, a scenario. Let's say
Mhm.
a house is on the market for $200,000.
Mhm.
The closing costs, let's say $7,000. Is it allowed for them to up the price of the house and put the closing costs in the price of the house? And you do a contract for 207 and have the lender pay those closing costs. Can the buyer actually put their closing costs in the price of the home?
Absolutely. Absolutely. Here's the deal. As a lender, we work from a contract. So as long as the buyer and seller agrees on a sales price
Mhm.
and they put it on the contract, we're gonna go with it.
Right.
We will just go with it. Now,
Mhm.
here's the caveat. Again, the house will have to appraise
Right.
for whatever the sales price is. And I've seen, this is what I'm seeing though. I'm seeing if those houses don't appraise for what's on the sales contract,
Mhm.
then the sellers are gonna lower the price, sales price, to whatever the appraised value is, and whatever that appraisal comes back at, the difference they're gonna subtract out. So, say for example, it was 207, and then the house came back in at 205. They're gonna lower that house, the sales price down to 205, but they're also gonna deduct that $2,000 from closing costs. So buyers really need to save money because you never know what can happen during this process. But of course, again, let me reiterate, they can do that. They can raise the price of the house to include their closing costs. Lots and lots of people do it.
So
All the
there's help out there, even though it's a seller's market. There's some help out there. I don't want people to get discouraged, and this is why I brought this show to the air, so that you don't have to be out there wondering about, can I do this, can I do that. We're going to be the professionals to tell you right here on this show what you can, what you can't do, and how to prepare and get you ready to purchase. Got a couple more questions for you, Vanessa. Once you come in and get pre-approved, how long is that pre-approval good for?
Well, your credit report and your DU findings are good for 120 days. So at the end of that 120 days, we're going to re-pull your credit and we're going to rerun you through DU. So what I typically tell people is you got 120 days. So the first 30 days you can spend looking, and then the next 45 days you need to spend trying to close on your loan because you don't want all that stuff to expire.
Right.
Because if you do, if you allow it to expire, then things could change very drastically, especially if, for example, something new shows up on your credit report. Um, you lose your job. You know, there's so many things that could happen in a 4 month time span. So, and not that I'm trying to rush people into buying a house,
Mm-hmm.
but if you know this is good for 4 months, then I will hop on it, because you never know what the future holds for you.
Right. And what are the interest rate right now? Interest rates, where we're looking
Oh
at.
man, the interest rates are fantastic. Today, I spent like probably an hour or so just locking everybody I could in because you got 30-year fixed rates in the 2%, 2.5, even as far down as 2.2,
Oh, that's low.
75. I mean, they're awesome. Now that doesn't mean everybody's going to get that interest rate. That means that if you got fairly decent credit, um, you're you're more than likely gonna get a rate in the 2%. But even if you have not so great credit, so you're down to a 600 credit score, you're still gonna be in the 3%, which still isn't bad at all. Because I can remember interest rates at 6 and 8%. Huge difference, huge difference. So now you can buy a lot more house than you could 2 years ago.
Right. Okay, so it's very attractive right now for buyers want to get out there and buy a home. So interest rates are low right now. We do have your 401ks on your side right now. You can have a gift to purchase a home. Sellers can pay your closing costs. So don't get discouraged if you're out there trying to buy a home. All you have to do is make that call to myself or to Vanessa, and we're going to get some information out there. And one last question I have for you, Vanessa.
Sure.
Why should a buyer call you to do their loan?
Um, uh, because number one, I know this sounds crazy, but I throw it out there because it's the truth. I have a lot of experience. I mean, I've been in the game for 20 years. And I when I first got into the business, there were a lot of people out there who thought no one in their family had ever bought a home. And they thought there were so many barriers to buying a home. They thought it was impossible, but it's not. It's not. And I try to get people to see that they can do this. I don't think a lot of people realize today, and Sean, you probably are aware of this, but they're paying more for rent than, you know, for example, my sister, and I tell people this, she went and rented an apartment for $1,200 and she had a two-bedroom apartment. You can buy a house, especially if you're a VA borrower, you can buy a $200,000 house for $1,200 a month.
Wow.
I mean, and I want people to see that they can do this. Yeah, it's I try to factor people in instead of factoring people out. Um, and I think I listen to people, and I try to guide them in the right way. I don't try to take advantage of anybody, and I'm gonna be honest, sometimes a little brutally honest, but that's what you need. You really, really do. I used to try to be so sweet and try to talk nice and try to, just be politically correct. But sometimes people just need to hear the truth, and it doesn't necessarily mean it'll be negative. But some people perceive it as being negative. But I'd rather tell you the truth and help you through it instead of trying to baffle you with bull and just have you waste money. And I think there are people out there like that, and I'm not. Um,
Right.
I try to treat people the way I would want someone to treat me or, my children. And so I think that's especially first time home buyers. People who are financially savvy, they don't probably need a person to hold their hand throughout this process. But there are people out there who need their hand held.
Right.
I don't mind doing that. I don't
Right.
really, really don't.
And that's why I've been sending customers to you because over the years I've known that you will do that. You
Mhm.
work good with the real estate agent. I know you have with me, and we've gotten people that have experienced buying a home for the first time and just
Mhm.
made this like riding a bike until you take the training wheels off and you get to that closing table and you sign that paperwork and we put those keys in your hands. And it's no better feeling to help someone to get to that next phase now in their life. And this is what we do. This is why we do it. And I want to thank you for what you've done over the years to help me to get my lenders approved. And even when I was a loan officer, you helped me. So, yeah. So I want to thank you for coming on the show. Before you go, I want you to give my listeners your information, how to
Okay.
contact you, your office hours, and all that stuff.
Okay. First of all, you can contact me either by just, um, calling me or texting me at 706-755-4812, or you can shoot me an email at vfox@gillmortgage.net, or you can go to our website and just Google Gill Mortgage in Augusta or in Evans, and I'll I'll pop up on the screen for you. Um, and those are the easiest ways to reach me.
Okay. All right, Vanessa, I want to thank you for your time this evening. We'll have you back on the show. Um, if you need to get pre-qualified for a loan, we did have our Zoom room set up today. The Zoom room is a feature of the show where After the show is over, we've already logged off and all of that. You can actually log into the show and get right on a Zoom call with Vanessa and myself, and you can get pre-approved right on the spot. So can actually be sitting at home right now with your family thinking, hey, I want to get pre-approved for a loan. Well, all you got to do is comment in the chat, send me a text message. My number is 706 414 7500. And next show, we start having those things on the screen. This is our first show. We got a lot in store for you. So we got a little growing pains we got to do. You might hear a slight echo in my audio too, so we'll have that fixed next week. But Vanessa, I want to thank you for coming on the show, and you have a nice evening. Okay, you can go ahead and log off now, and then I'm gonna continue the show. Okay.
Okay. All right. Thank you.
All
Okay.
right. Thank you, Vanessa.
Mhm.
That was Vanessa Fox from Gill Mortgage, and she can help you with all of your home loan needs if you're trying to refinance, purchase, whatever it may be. There's a segment on this show called Ask Your Realtor. We're not going to do it this segment, but you can always send me your questions on social media. At the end of this, you'll see the social media links. I'll answer all your questions online. I'll be doing these segments throughout the series that we have, the Home Professional Networks, on the air. And it'd be another way for you to connect with your realtor to get things done. Now, we have a segment on this show called the Listing Showcase. This is where myself and other realtors can come on here and list their homes. And we have a nice one right here online. This is over in Ellsbury Commons, here in Augusta, Georgia, right off of Bel Air Road. It's 3504 Bedford Court, 3 bedroom, 2 bath, and it's listed at 175,000. And let's see, there goes a picture. You can see it's a nice home here, very well kept. And you can be in this home. You can call me. I can get you in touch with Vanessa Fox. You can get pre-approved, and we can get you going with the loan. We have a segment of this show where I bring up the chat, where we actually will answer questions that you may put in the chat box. So I just wanted you to see another feature of this show. Next week, we're going to have Corey Johnson from First Choice Home Inspections. He's a very well known person here. He's used to be one of our county commissioners, and he'll be on the show to talk about his business, First Choice Home Inspections, the importance of getting a home inspection, and how it could benefit you. So that's a few other things that we wanted to bring to the show, different aspects of buying a home. I want to give you a little bit of my background, and then I'm going to go. We're going to sign off. I just want to let you know that, again, my name is Sean Williams. I'm a real estate agent here at Maybaum Real Estate. I've been in real estate for about close to 20 years. I started off as a loan officer, and then I crossed over and got into what I really wanted to do, which is be a real estate agent. I've always been in radio broadcast. I used to be a radio DJ here in Augusta, and then I took those talents over to a couple of radio stations here doing the Home Professionals Network as a loan officer, and I decided to continue to do it as a real estate agent. Um, I hope everybody is being safe out here. I want to let you know that during this COVID experience that we're going through, this pandemic, as a real estate agent, I want to do everything that I can to keep your family safe. I want to make sure that we're taking the precautions when you are purchasing a home. I know this is a difficult time. Some of the things that we are used to doing, accustomed to doing, we can't do right now. So I'm offering virtual tours. I'm offering Zoom conferencing. When we go out to show a home, we will be masked up. We're keeping you safe as we go into these homes every day. We'll be masked up. We're not doing a whole lot of in-office meetings right now. I'm in a conference room at my office right now, and I'm here alone. That's why we brought Vanessa in virtually. But we're going to do the things we need to do to keep you safe. We want you to be able to move on to the next level in your lives, and we don't want you to have to end up in a hospital doing it. So, during this COVID, and I know we're going to get back to normal times. We're going to get back to life the way it was. And I pray for each and every last one of your families and that we get through this together and we get through this safely. I want to dedicate this show. First, I want to thank everybody that has stood by my side through my real estate career. My family, my friends, my customers, um, loved ones. You've been by my side. Here recently, a lot of you already know my dad passed, and I'm dedicating this show to you, Joe Williams, my dad. He passed probably last month, and one of the last few things I remember him saying to me was to do good with my real estate and get out here and treat the people right and serve the community well. And that's what I intend to do. Rest in peace. You will be missed. You'll always be loved. I'm dedicating this show to my dad. Well, that's it. We're going to get out of here. Tune in next week. You can always subscribe, click your notifications so that you can always catch the show and you get notifications when we come on so you can catch the show when we broadcast. Share this show. I know a lot of people are working right now. You can always look at this show live online. I mean, rebroadcast online. It'll be on my YouTube page. So until next week, I'm the Home Professionals Network, and we're changing lives one home at a time.